After a few days worth of the market actually cooling down now from the Nvidia and AI hype, not only has the tech-heavy Nasdaq lost momentum, but so too has the S&P 500, now just barely ending the week in green. But this sell-off has now forced investors to look elsewhere into sectors long overlooked for buying opportunities, 3 of which I have for you today, all burdened down by our economic environment, making each of them ripe for the long-term buy and hold. So, are you ready? Now, before I dive into these 3 dividend stock picks today, I want to go ahead and just restate the obvious and the importance of coming to understand why I'm even looking in their direction in the first place. First of all, they all deal within the construction industry, which has been absolutely battered as we linger in the uncertainty of when exactly the Federal Reserve will make their chess move to cut interest rates down. And this is now exactly when I want to make yet another plug for macros mattering. Not to time the market, but just to come to understand where exactly to look for opportunities. Now, hear me out. Not only has the housing market been in complete shambles, with say existing home sales notching down lower and lower as mortgage rates and home prices just continue to soar, but so too are new home construction projects. They're all battered down, in addition to any major projects out there, whether on the local, municipal, or federal level, because of high cost and hard to come by funding across the board no matter the project. And moreover, there are just exacerbated supply chain issues right now, driving up prices for building materials to be transferred, or heck, even just the cost to produce the actual materials in the first place, as well as labor that is needed to produce those materials. So this leaves us with now a few opportunities to consider, and all thanks to our economic environment. Now, this environment is not going to last forever, so just keep that in mind as we kick off into our first opportunity with Caterpillar, ticker symbol CAT, which is a global player in the arena of manufacturing, construction machinery, and engines. I am talking about the real big machines and vehicles out there needed for literally building any major construction project. Now, at the onset of the year, when expectations were high that interest rates would actually come down, Caterpillar was on fire and on the rise. However, as we advance into the second half of 2024 and those expectations have almost disappeared, over the last 3 months we're down now by almost 7% with a PE ratio at 14.8. But this is where I say I want you to be long-term on Caterpillar, because zoom out and we'll see almost 300% worth of share price appreciation. Of course, this is not going to be your overnight 10x bagger, but it's a steady, reliable pick to which analysts forecast it will be back on the rise again, shooting up to $375.91 per share. It's a little over 13% worth of upside. And until then, Caterpillar is there to lend a helping hand in helping you build a dividend income stream with a growing dividend yield currently at 1.71%, growing on average by about 10% year over year, and doing so uninterrupted for the last 31 years. Next up, a dividend stock pick that is more relevant most likely in your everyday life, Home Depot, ticker symbol HD, which is actually the world's largest home improvement retailer that is currently hit by weaker personal consumption numbers, while Home Depot continues to report that their customers are spending less on big ticket items and taking on smaller scale home improvement projects. But in knowing Home Depot's sheer size and leadership in the industry, this 3-month slump by over 7%, now at $350 per share, is looking great to me. While it's actually up nominally on the year, but zoom out to see just about 446% worth of share price appreciation, and all my rationale to stick with it for the long term. Now, as for analysts, they remain optimistic, just as they were with Caterpillar, predicting over 12% worth of upside, hitting a share price of $394.36 per share. And until then, you're going to go ahead and be the beneficiary of a 2.56% dividend yield that's been on fire in terms of growth, growing by an average rate of 19% year over year for the last 20 years, after remaining on a dividend streak untouched here for the last 36 years. Now, investors, this last bet is actually a bit riskier, but one I think is quite interesting of a play, a holding that I actually made a swing trade on and profited from. But before I actually cover it, I want to go ahead and ask you to join me here on the channel by subscribing. As this channel just continues to grow and we reach more people, I can only guarantee you that I'm going to produce more videos, endless insights, and stock ideas, and better masters of the market chats. So I want you on this journey with me. Now, in addition, let me know that this is the content that's feeding your value appetite by tapping on that thumbs up button for me, which literally just lets me know that this is the content you want to consume, and I'll then make more just like this. All right, with that all out of the way, investors, let's get back to it with Stanley Black & Decker, ticker symbol SWK, which I know it has not been the hottest performer lately after free falling by over 54% over the last 3 years, really since the COVID construction boom. But if Home Depot sales have been down, as reported by Home Depot, declining by roughly 11.5% year over year, and Stanley Black & Decker is their manufacturer and supplier of some of their top shelf tools, whether it's DeWalt, Craftsman, and Stanley, I can only imagine that across the board, bottom line, brass tacks, wherever we go to these home improvement retailers, they are all being hit hard, and therefore Stanley Black & Decker is actually feeling the sharp pains of all of that. So it's no wonder why we see it's down on the year here by 12%, trading for $84 per share. But that doesn't scare me, because zoom out, we see over 21% worth of share price appreciation, while also noticing how much this stock actually fluctuates over time. Now, I factor that all in and just say that perhaps long term, this could be an interesting bet for us. After all, hedge funds have only been buying, while the rest of us have actually just been too nervous to touch it. Now, we see over 128 shares purchased by Smart Money last quarter, not to mention analysts who just continue to promote their optimism here, forecasting nominal upside to hit a share price of roughly $88 per share. But here is why Stanley Black shouldn't be overlooked for dividend investors, as it still rates safe on Simply Safe Dividends, coming in with a dividend yield at 3.82%, growing by an average of 6% year over year, but most impressively without interruption for nearly 150 years, 147 to be exact. However, I now want to know what you think about Stanley Black, as well as Caterpillar and Home Depot, so go ahead and drop your thoughts down in the comments below. Are you buying, looking elsewhere? Let me know. Subscribe to never miss another stock idea, and of course, just be sure to dive right into more insights right here now.